We've just spent the last 45 minutes or so on a panel talking about opportunities and concerns around Brexit and things facing the city. One of your concerns is the costs going up for businesses if we see fragmentation of clearing. Do you think that that cost is fully understood on the other side of the channel?
Well, first of all, Anna, let's remember that the largest European countries at the moment are in a sort of full electoral cycles, let's put it this way. And so some of the rhetoric at times, of course, tends to perhaps exceed reality on the ground, and that's been definitely the case over the past few months in the European Union. What we've sought to highlight, and the benefits, of course, of global financial services that are offered, not just, by the way, to EU-based investors, pensioners, and corporate issuers, but global issuers and financial market participants, is just that, the benefit of global services. Since 2008, since the G20, it was decided, including by European nations, European Commission, United States, UK, and others, that clearing should stand at the heart of the world's financial services. And I do think that the efficiencies that come and the risk reduction, and it's very, very large, the risk elimination that comes from centralized clearing, particularly in the world's over-the-counter derivatives market, which is the largest financial asset class, is fully understood in Europe, including by the Commission, whose recent proposal, we noted, was quite balanced and offered several ways forward, including a shared regulation, which is a framework that we already operate between, for example, the United Kingdom and the United States.
And you're clearly mindful of the costs that this imposes then on people who want to do this business, that the cost goes up if it's fragmented. But it's also an issue because of LCH ClearNet, the business that you operate. Are you already losing any business because of concerns that euro clearing will be forcibly moved from London into the Eurozone?
Well, not at all, but I think if you look at our first quarter earnings, you can see that flows are actually increasing and quite substantially. So that's not the case. But I would say several things. Is that the political case, it is not an economic or systemic or regulatory case. The political case that has been made by some to extract out of the global engine that is in London, as you pointed out, that is cleared by the London Clearing House, which today clears almost 95% of the world's over-the-counter derivatives. The political that has been made case does not fully comprehend the increase in systemic risk that is mathematically verifiable, that would result from extracting from this global pool the euro-denominated pool pertaining to EU-based institutions, which, by the way, only represents 7% of the total. So you'd end up, and this is important to understand, with a very small fragmented pool. Systemic risk would be increased because collateral management would, of course, be shared with far fewer entities, just European banks.
There are some in Europe, though, that think that it's a risk they don't want to bear, having all of this euro clearing taking place on the doorstep but not directly supervised by the EU, because they fear that they can't necessarily rely on swap lines between the relevant central banks always operating without the necessarily regulatory control.
First of all, it's not a London Stock Exchange Group issue. We operate clearing houses and infrastructure around the world, so in the Eurozone as well as the UK, the US and Asia. But let's go back to that point. It's an important one. If the EU were uncharacteristically, the United States, for example, have no issues with US-denominated products being cleared in the UK. By the way, that represents 60% of the total flows. EU flows only represent 28% of total flows, and only a quarter of that 28% originates from the EU. So if the EU were to extract somehow through regulation, by the way, which all would have to agree to, and in the absence of a determined regulatory framework, there's still a debate as to whether, even in the EU, as to whether it should be the ECB that regulates this business or the national central bank. There's still a regulatory framework that is less than fully formed and certain. But if the EU were to somehow separate this, you'd end up with a very illiquid, which means riskier from a systemic perspective, far more costly. We have costed that based on a very rigorous analysis. This would cost in the region of 20 billion euros a year of additional margin, a cost that over 5 years, obviously. The math is simple.
You've been writing about that quite a lot recently. Can I ask you another question about the future then and opportunities? Because we talked about the GCC in the panel that we were just on. Do you see big opportunities in Saudi Arabia, for example, where you've just been with the Prime Minister? Are you still in the running for the Saudi Aramco IPO?
Well, I'm not going to make any comments about specific, but I want to make one last point about the clearing point, and it's an important one. If the EU somehow, through some political preference or priority, were to decide to create an isolated, fragmented, illiquid, and smaller pool of EU-originated, euro-denominated clearing flow, it would also, in our view, do lasting damage to the European Union and Eurozone members' desire to make the euro a global reserve currency. Because, of course, protectionism cuts both ways. And that would be the end of the euro as a global reserve currency. Now, I'll get to the other points. We have seen, and I think our first quarter numbers have shown, amazing growth in all our businesses, including in our IPO businesses. So more than ever, exchanges like the London Stock Exchange underpin the need for diversifying sources of capital raising for the benefits of small companies, startups, scale-up, big companies as well.
Still looking for business in Saudi.
Very, very attractive as a global IPO platform. And that's all I will say on that subject.